Hello, hello, hello. So I'm pretty pumped today. I'm so pumped. I don't even have bloody time for sleeves. This is how pumped I am right now. The crypto market is going a bit crazy. Everything's in a massive whirlwind. To the downside, unfortunately, it's not really the direction we want. But I do want to tell you exactly why it is that this is happening. There's a very clear-cut reason as to why Bitcoin keeps falling. And I'm going to tell you exactly what that is and how we can play that to our advantage. And also look at some of the technicals to see where that bottom might be with our friend AJ, and also dropping in a little bit of news about USDD, because as you know, I've been keeping you up to date with that since, probably about a month now. But anyway, AJ, how are you today? And how are you feeling? Probably not great, I'd imagine.
Well, yeah. Personally, I'm doing well, but my portfolio isn't doing too well, as is pretty much everyone's. But yeah, so we've got a lot to talk about today. I've got some on-chain stuff to show you, the signals that we are sort of at that bottom vicinity, but there is potential for more downside. So we'll get onto that in a moment, and then that will bring us onto the charts. So stay tuned for that.
Yeah, that is the thing. I feel like we're definitely near the vicinity, but it's just kind of calling it, calling it exactly.
Yeah.
What I will show you though, jumping straight in, this is the reason why we are in a down or in like a massive bear market. And it's not just in crypto, guys. We'll just quickly bring this up. Investing.com. Let's have a look at this. Don't worry, we are not alone. You're not alone in this. We see that the NASDAQ is down by almost 5%. S&P nearly 4, Dow Jones nearly 3. You do then have what is this? Yeah, the US 30. So that is actually up, which is very surprising. But overall, we're very much down. Now, the reason, in fact, there are two reasons as to why this is happening. So firstly, Wall Street's favorite recession signal is back as curves invert. These are yield curves on the 10 and the 2-year Treasury bonds. That is one thing that's very important to know. When the yield curve inverts, you then end up with a recession quite closely after, and I'll show you that in a second. But also inflation, because of what we heard on Friday, it was pretty crazy, to be honest. That's really sent the markets into this massive downturn, and now we're looking at higher basis point hikes from the Fed. So firstly, yield curve inversion, 2 and 10-year Treasury yields inversions prior to recession. Boom, inversion, below 0%, recession in the gray. Boom, again, recession in the gray. Again, no recession, fortunately. Recession, gray, no, yield incurving, yield inversion occurring, gray for recession, again, recession, again, recession, again, recession, again, recession, and then again, tiny little recession there, but that was kind of more COVID related. So I don't think that this is actually a fair basis. So you can have a little bit of yield, inversion, and we did have a little bit earlier this year, but we've also had it again now. So if it goes below and stays there for a significant period of time, there's been great indications before that whenever this happens, we see a recession very quickly after. And that's what the big investors and traders are kind of looking at. Secondly, is we are looking at tomorrow. The Fed is going to announce its basis point hike. Is it going to go 50 basis points? Well, that's what was pretty much agreed unanimously last week. There was the prediction that 99.1% of the market said, okay, we're going to see a 50 basis point hike up to this level here, 1.25 to 1.5. 99% of the market, and now only 10.9% think that we're going to have a 50 basis point hike. So everyone is going for that 75 basis point hike. Hence why this is what's being priced into the markets. And we're seeing all of this downside here, risk off sentiment, money moving away from crypto. And also just to kind of show you that, again, monthly outflows. This is institutional flows in and out. Obviously, it's all out at the moment. Hence why it's all red from big institutions via these mechanisms here. But the overall, I guess, sentiment, and as again, you see previous week's probability, bomb, it's just downside, more and more downside. So people were expecting 86.9% to have a 50 basis point here, 50 basis point in July as well. But now, as you see, that's moved up. Even if we do get a 75 basis point move here, the expectation is another 75 basis point move here from 1.5 to 2.25, and that is what's predominantly priced in. And then again from that 2.25 up to 2.75, that's a 50 basis point hike in September, and then again another 50 basis point hike in November, with a little bit of an end of should we call it a Christmas pump? So if we are, which is what the market expects, at 3.25, then the most likely is a 25 basis point hike, which is where they kind of take their foot off the gas, and this is where the market can begin to breathe again. So this is what's causing a lot of the issues, and we see it across the charts. Just here, I'm still in log and I'm miles away. Yeah. Let's get on to what I wanted to talk about, which was actually USDD, USDC. So USDD, where are we? I'm on the weekly. Bring me onto the, yes. Bring me onto the 4 hour. So it's not looking great, guys. It's pretty bad. I've spoken about Tron a lot. AJ, what's your thoughts on Tron? Have you been following this story quite closely, or they obviously saying they keep adding to bolster the algorithmic stablecoin. What are your thoughts?
Well, obviously, algorithmic stablecoins, I just don't trust them because of, what's happened previously. So personally, I am staying away. But yeah, I just don't trust it. I just can't. He must know what he's doing if, he's following through with it after what has happened to Luna. So,
he's
maybe
controversy.
He is, yeah. Maybe he knows something that we don't, but as of right now, for me, I'm just staying away from all those algorithmic stable coins.
I know. I mean, when there are options like USDC, I just don't understand why. I do. I get it. There is yield. I get that. But you can just see it slowly de-pegging. This is since yesterday. Got a little bit worse. Relief pump after we saw that $50 billion and $1 million in Bitcoin was bought. I don't think it's yet been added into the portfolio, and we just see more downside. So currently the peg, it's de-pegging, it's $0.97, and this just sounds exactly the same as what happened with Luna when they said, hey, look, guys, don't worry, we're buying more stuff, we have more Bitcoin, blah, 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 blah. But as you see, the algorithmic stablecoin is de-pegging, so it's dipped as low as 0.974 before recovering. The stablecoin injected another $700 million worth of USDC. This is kind of to collateralize the actual USDD itself, and Tron claims that there is a 300% collateral ratio backing USDD's value. This means the DAO would need to hold about $2.1 billion worth of assets in Bitcoin and Tron, as well as other stablecoins. Now, just to give you a quick update, this has actually been changed. So this has been changed. Where am I looking? Yes, so the supply APY, the APY, if you remember, was at 30%. 30%, absolutely insane. Especially when everyone's like, oh, USDT was bad. Oh, UST was bad. It was at 20%, and then it went to 17. Well, this guy's cut it in half, and it's still bloody 15. It's absolutely insane. But what people are now worrying about is, well, actually, are they actually collateralized as heavy as they say they are? Now, this post really kind of throws a lot of dirt on that, saying that currently it's only 92% collateralized by the reserves itself. Now, and if you subtract Tron, it turns out collateralization ratio is only 73. This is a couple days old, so here's the new news. They say they have 246% collateralization. I don't believe it, guys, because here you see the collateralization details. They have a burning wallet. Now, I mean, if you have a burning wallet, surely that's not a reserve because it's been burnt. The idea of burning an asset is that it goes into a wallet and no one ever touches it. So I don't think that should count. So if that doesn't count, what we're left with is we have Bitcoin, USDT, USDC, and also Tron, and then another little bit of Tron. Well, Tron is going down very heavily. It's plummeting. The volume is up, but Tron is falling, so I would kind of be wary about having that as my reserve. Bitcoin price is falling, So I'd be wary about that being part of the reserve. And so if you add these together, even these three, they only equate to $1.059 billion. So that's a collateralization ratio of only about 146. Obviously, if you include the burn wallet, then yes, you do end up with 246 or whatever, but you shouldn't. So realistically, because I mean, if you do, then what is Tron worth? If you're burning all of this Tron and actually it's not actually burnt, it's just been put to the side, but it's ready to be brought into the market, that's going to tank the price of Tron and then affect this reserve that you have here. So realistically, looking at this, they're only about 146% collateralized, even though they're going around saying how, we've got 200 and 46. This is a lot of talk to try and calm the investors, which is exactly what happened when we saw UST collapse. And yeah, as you see, obviously, a lot of people withdrawing their money, a lot of panic in the market across all of this, I will say. Now, there's even a discussion that in Just Lend, they have JUSD, which is essentially another stablecoin based on the Just Lend protocol that they are then taking and staking again. Things like $140 million. So this might be the reason why the TVL, the total value locked, is going up, because it's actually manipulation by Tron themselves. So I don't know, guys. Let me know down in the comments what you think. Personally, I'm inclined to stay away from this. I don't think that they are kind of collateralized to the level that they say they are. And I think it's a lot of marketing to make them look safe and make everyone not worry. But I think once you dig deeper, the same as what people were doing with UST, you're going to find a bit of cowboy actions, shall we say. Let me know down in the comments, what do you think? Are you a fan of USDD, I should say? And do you see any similarities? Let us know. But until you kind of give us that bit of information, let's look at some on-chain stuff to see where we can find the bottom. Because obviously this is affecting, all of this bad news is weighing on the price of Bitcoin. But if we actually have a look at what we can see, it's a very different story.
Yeah, so just to let you know, we are currently trading at around the $22,000 region, and we are below one of the most significant and fundamental on-chain metrics, the realized price, which is this chart on the screen right now. This metric represents the average price of every coin in the supply, valued at the time it was last spent on chain. So as of right now, the realized price is currently sat at $23,340, and is this orange level is rarely visited by spot prices outside the deepest and latest stages of bear markets. The last time the market held an unrealized loss were in March 2020. We know that as a COVID crash, and at the ends of the 2018 bear market. So this indicates to me that we are near the bottom. It doesn't indicate that we are at a bottom. It just indicates that we are very close to that bottom, because as of right, this is slightly behind, but as of right now, we are currently below that realized price at $23,340. Now, we don't tend to stay in this under the realized price for long. So you can see in the 2018-2019 bear market, I think it was 6-7 months we were below this level, and in March 2020 we were below this level for around a month, I think it was. But the majority of the time we are above this level. So this is what's indicating to me that we are in that vicinity of the bottom, or close to that vicinity of the bottom. And yeah, I don't expect we are going to stay within this area for much longer. For very long. But there is still possibility for more downside, and that's what actually brings me on to this one right here. So next, this is the MVRV score. This compares the spot value of Bitcoin against realized price to obtain an oscillator. This tool can help us identify statistically meaningful deviations away from its intrinsic value and is used to assess over and undervalued conditions. But nevertheless, over the past bear cycles, has shown that negative MVRV values are often seen before a bear market concludes and can persist in the same state for some time. So basically, what I'm saying is that towards the end of these bear cycles, we do tend to see the MVRV score, come down below this 0.0 level, which is this black line. You can see 2018, 2019, that bear market, we did come below it, and we did come and test this minus 0.5 level, which is this red line at the bottom. The COVID crash, we did the exact same thing. Now, we are currently between the 0.5, which is this blue line, and the 0.0 line, which is that black line there. So this indicates to me that there could be more downside. We could come. The last two times we've tested this minus 0.5 level at the red line here. So, there is a possibility that we can come down and test that level again. And that, brings me on to the Bitcoin price model. So what is it? Well, the Bitcoin price models, it sort of gives us an indication of sort of the market tops and the market bottoms. So this green dotted line here has previously, signaled the market top back in, when was this? This was back in 2013. So it signaled the two tops back in 2013. It signaled the top in 2017, 2018. December 2017, I think that was. So, this is a pretty good indication of when the top is. But what we are looking at is the CVDD, which is this pink line down here. And the CVDD, that sort of signals the market bottom. So the CVDD is just shortened for cumulative value days destroyed. And historically, it's picked the bottom for the market. So when coins pass from old investors to new investors, the transaction carries a USD value and also destroys an amount of hodl time by the previous holder. So the CVDD is the cumulative sum of this value time destruction as a ratio to the age of the market and divided by 6 million as a calibration factor. So previously, this CVDD, has signaled the market bottom. So back in 2015, you can see here, I know it's a bit hard to see because the mouse keeps going over the top of it, but you can see just above where the mouse is right now, you can see that we did bounce in 2015 on this CVDD, this pink line. Again, we bounced off this level in December 2018, as you can see right there. And we came pretty close to it in March 2020. We know that as the COVID crash. But what I want to bring your attention to is that currently the CVDD is currently sat at $15,359 at this moment in time. Now, this can vary, as the weeks go on, but as of right now, we're sat at around $15,000. Now, previously, because this has signaled the bottom for these bear markets, it's pretty obvious we are in a bear market as of right now. The question is, are we going to come and test this level again? This $15,000 level, is something I have mentioned previously as well, and I'll show you in the charts in a second. But, I do think there is a possibility that this $15,000 level is, a realistic target. And I will show you why over here on the chart. So we do have this head and shoulders pattern that we have mentioned, previously before. We have the left shoulder, the head, and then we have the right shoulder. And we have actually, broken out of this level. Ignore what's going on with these candles right now. TradingView is, having a bit of a silly time. I don't know what's going on with it. Hopefully that gets sorted out in a moment. But basically, this head and shoulders pattern has broken towards the downside. And it does actually give us, so from the breakout point, it does actually give us a target of around $15,000. And that, lines up perfectly with this CVDD bottom that, the CVDD is indicating. This indicator is indicating the bottom is at $15,000. And this, technical pattern is indicating that we could come down to $15,000. Now, you know, it's hard to say if that's going to happen, but there is a possibility that it is. You know, we are currently sat just below $22,000. We are at this moment in time testing that 200 MA that I've been talking about for, you know, quite a while now. I don't expect a weekly break below this level, but I do expect to see, you know, wicks down below this level. Now, the $20,000 level is one level I'm looking at us wicking down towards because, you know, obviously previously that was the 2018, 2017, all-time high. So that is a level that I'm looking at the price, you know, wicking down to. But, you know, there is also this $15,000 target that I do think there is a potential we could wick below it. So that's, you know, from where we are now, that is around a 33% move. And where we are right now is at that 200 MA level. Now, previously, you know, when we have wicks below this 200 MA, we have wicks below this level close to 28%. It was around, you know, 27, 28% wick below this level. Now, that can signal, you know, that signals that we could come pretty close to that $15,000 target, or even hit that $15,000 target. So around a 28% move to the downside would bring us to $16,000. And, you know, what is another $1,000 move for Bitcoin now? You know, from our all-time high, we are, you know, down so much. So what is another $1,000 move for Bitcoin? You know, as you know, right now, $1,000 Bitcoin, $1,000 move for Bitcoin, you know, is just nothing. So there is a possibility that $15,000 target could be hit. And now, I want to be dollar cost averaging into Bitcoin. I have been saying that I was going to start dollar cost averaging into Bitcoin at 24,000. As of right now, I haven't done that because we did just smash through $24,000, and you know, I still haven't started to dollar cost average into Bitcoin. What I do want to do is, you know, show you how I am, you know, dollar cost averaging into Bitcoin. So we are going to have another video where we are going to show you our bear market portfolio strategy. So stay tuned for that. But basically, what we're going to be doing in that video, and it's going to be a series, you know, it's going to be a continuous series. We're going to have a $500 account and we're going to have a $5,000 account. So the $500 account is to sort of show you that you can start off with small amounts of money. You don't need thousands of pounds to, you know, start trading and start making money within crypto. So we want to have that account just to show you that you can start off with, you know, limited amounts of money. And then we're going to have that $5,000 account as well, because you know, we want to show you you know, how much you can make once you sort of get to those levels. So we are going to be doing that. And yeah, as of right now, I haven't started dollar cost averaging into anything as of yet, but that's what we're going to be showing you in that, you know, little series that we're gonna bring to you. Now, because we do have this $15,000 target, that is, you know, sort of holding me back from starting to dollar cost average. I am going to start dollar cost averaging at, you know, this $22,000 level, but I am going to go very lightly because I do think, you know, there is that possibility of that $15,000 Bitcoin. So I'm going to start off lightly, and this is what I'm going to be showing you in the portfolio strategy. I'm going to start off lightly and then get heavier as we sort of go down, because I do think $15,000, I think, you know, it's just a pretty realistic target. You know, the on-chain stuff is telling us there is more downside for Bitcoin. You know, historically there has been more downside there, so you know, I think there could be some more downside here. You know, the CVDD, that's at $15,000. That has signaled bottoms in you know, the bear markets previously. So I do think $15,000 is a pretty realistic target, but I don't think we'll stay there for long at all. You know, looking at the Bitcoin realized price, if I just take a look at that, we haven't stayed down there for long. So, you know, I think, you know, it would be a quick wick down there on the daily. Sorry, it would be, you know, we'd maybe have a candle close down there on the daily, but on the weekly, I think it would just be a quick wick down. And I'm still expecting Bitcoin to hold this 200 MA, you know, that we are currently sat at. It currently sits at $22,300. You know, just quickly, previously, you know, we have held this level. So I am expecting Bitcoin to hold this on the weekly. If we do break below it, then, you know, I'm expecting a bit more of a prolonged bear market. But if we can hold it here, then I think, you know, 6 months and a little bit over 6 months is a pretty realistic target for, you know, sort of the conclusion to the end of the bear market. Personally,
I'd probably agree with you there, AJ. Yeah, because I think, you know, once, like I said earlier at the beginning, was, you know, we are having a, you know, a higher, well, it's going to be expected that we have a higher interest rate, and I think that's what's being priced in now. So these rate hikes, they are going to continue, and obviously they're at a higher level, hence why we're seeing this massive push to the downside. But the expectation is then, you know, with quantitative easing, with this, with the rate hikes increasing, you know, now, because no one has faith that the Fed can manage inflation, so they have to do something pretty crazy, which, you know, by the sounds of it, pretty much sounds like a 75-point basis hike. But then, like I said, towards Christmas, we should have that kind of rally where there's only a 25 basis point hike, reducing from that 50 that we'll see probably around November. So that's where I'd probably agree with you. I think I'm going to put maybe 6 months, potentially, depending on how QT goes, quantitative tightening. I think we're probably, you know, maybe a 5 month kind of bear market. And like you said, 22K is a really good price to buy at. But do we want to buy it when we're on the way down, or would it be better to wait and then buy it when we're on the way up?
Exactly.
And, you know, you don't want to try and catch a falling knife.
No, exactly. Yeah. So I think 24,000, you know, I had been saying I was going to dollar cost average there, but the price was smashed through that level. So, you know, I didn't sort of, I didn't actually, you know, dollar cost average in that level, but that is a resistance level as well. So, you know, like you said, we want to catch it on the way up rather than the way down. So 24,000, even that is a great buying opportunity when we are on the way back up. So, you know, when we sort of find that bottom and we break through, because 24,000 and even 20,000, you know, those were previous resistance levels. Those were previous, you know, all-time highs. So if we break below those levels, you know, you could, you know, stay, just you know, hold back from entering into the positions. Personally, I'm going to be dollar cost averaging in, but another way you can do it is hold back and then basically buy the breakouts of 20,000 and 22,000 or 24,000. Though that's another good way to do it. Personally, I prefer to dollar cost average because, you know, that sort of gives me the best possible price that I could have gotten in at. So that's the way I'll do it. But yeah, like you said, you know, you can catch it on the way up.
Yeah, and just to kind of wrap this up here, guys, you know, there's two things. So obviously, like AJ said, we will be having a portfolio series of videos where we walk you through those two portfolios. But, you know, the reason why we like to DCA, dollar cost average, is because, you know, it removes a lot of the emotion. And when you're dealing with a portfolio, that is the number one rule, is just to take emotion off the table as much as you can. So if you try and only have one entry, you know, that entry, it's very rare that it's going to be at the exact bottom. And if you only have one entry, you're going to be thinking, I should have got in at this stage. I should have gotten in at this stage. But with DCA, you know, you take the emotion out because you're happy to buy at, you know, 21,000, at 20,000, at 19,000, you know, and then when it starts going up, let's say, you know, it only gets to 19 and it bounces to the upside. You know that you've got in at 19,000, as opposed to, you know, trying to go all in at once and then messing it up. And then that just plays with your emotions, I think, more often than not, which is more detrimental to your portfolio than arguably anything else.
Yeah.
But yeah, make sure that you guys stay tuned. We will be releasing the portfolio videos. And obviously, you know, we'll have those two different ways of going about it. One will be kind of like more trading. Another one will be slightly more on the DCA side. And then we'll do two different account sizes. But I'm really excited for this, to be honest. And I want you guys to kind of join us along the journey.
Yeah. This is the time to, you know, be sort of building these portfolios within the bear market. This is, you know, the perfect time. This is when you accumulate, and then the bull market, you know, that's when you see your portfolio just absolutely explode. So, you know, I think the best time is, you know, to start creating those portfolios now. And obviously you can follow us. You know, we're just going to be showing you what we are doing personally with our portfolios. And this is sort of going to be a community portfolio that we're going to share with you and show everything that we are doing. We are not going to do anything without showing you what we are doing.
Yeah, absolutely. So there you have it, guys. Make sure you stay tuned for that. Hope you enjoyed the video, and we look forward to seeing you tomorrow. And well, actually, in the next video.
Yeah. Thanks for watching, guys. Slap that like button.
Yeah, and don't forget to subscribe.